So, James, a lot of traders now, or markets pricing in maybe up to 5 rate hikes from the Fed this year. What are you anticipating?
Well, I think it's the market is not wrong in terms of trying to expect a more hawkish Fed, given the sustained price inflation we've seen globally. But I do think in terms of pricing, markets are always overdo things, and our view, or actually my view, is that we don't expect Fed to need to hike rates so aggressively, because we are entering into a sort of slowing growth phase, coming up from a very strong growth last year into this year. And supply bottlenecks, although in a lot of the speakers in your shows are still saying supply constraints are still there, but there is certain hope that it would be mitigated going into the second half. So there is a however slim chance that price would at least moderate. So hiking too aggressively into a slowing growth and perhaps tipping off in from high inflation levels could be dangerous. So personally, I think the Fed would take a little bit of time and patience, and as ever, data dependent.
Well, we've seen, obviously, markets selling off pretty heavily. The CSI 300 now in a bear market, as is the Kospi. Here in Australia, we're in a correction. But when you look at all of this selling, are there parts of the market that look a bit oversold to you? Do you see some opportunities here?
Yes, indeed. Although it may be too early to call the bottom, but on the other hand, we still think the underlying fundamentals in U.S. Or actually, closer at home in China are actually not too bad. And there are pockets of opportunities for the fairly longer term investors, although investors must accept that the sort of low interest rate regime is over. So your sort of future looking stance must incorporate that into consideration. So I mean, from our side, we're definitely seeing some pocket of opportunities in some of the laggards all over the world. Some small caps in the U.S. perhaps they've been lagging behind tremendously even before the sell-off.
Right. Let's talk a little bit about China, because of course they were lagging behind given all of these issues about regulatory crackdowns and the sell-off in tech as well. But this GTV chart on the Bloomberg showing that really value stocks within the CSI 300 have been outperforming. And you mentioned perhaps the time of low rates is over, but not necessarily in China, right? Could you see some more upside here?
Yes, indeed, I totally agree. I think the policy stance in China is definitely in contrast to the States or developed economies. There are a number of more market-friendly measures that's being implemented recently, and perhaps more specifically in the property sector. While the property equity market would still be quite sensitive to news every day, we are seeing some of the Asian high yield bonds, which include some of the high yield names in China, start to look pretty attractive in terms of yields. But of course, risk remains.
Yeah, tell us a little bit more about that, because we continue to see this talk about restructuring Evergrande. When is the right time to actually get in? Is this already the bottom where you see opportunities, or could we see some further downside and you would wait it out?
Yeah, we think perhaps in terms of the top-down tightening stance of the Chinese authorities may be probably behind us, and now we're entering a stage where we need to see some results. As you mentioned, definitely the restructuring of Evergrande and perhaps a few other troubled property developers. And definitely, it's a waste of time because, especially overseas, the creditors are less impatient than the issuers themselves. So we think we're entering into a stage where the market is almost in terms of finding the equilibrium level of debt or yields, it's starting to look very attractive. For example, if you look at the Asia High Yield Index as a whole, it is giving you about 12% return in terms of yield to maturity. Although there might be sporadic write downs here and there, but it's starting to look the risk return. It looks favorable if you have a long-term horizon.